We know there's a deadline. It could be a Fed meeting. There could be a major change of policy announced. We have a deadline. We have a meeting. How markets trade into that. The market moves. What happens around that time, which is kind of when you don't want to be involved, in my opinion, because it's just erratic craziness that's going on. Liquidity is a major issue, and then it's the aftermath. And I think that's kind of where we are. So, when you've got a market that is fixated on a theme, a date, or whatever. And it's how market, that's when headlines become an issue, because it's how that headline changes that middle date.
Yeah.
And that's when, as we get closer, you'll see things really react. And that's very hard to trade those kind of situations, because you've got to predict the headlines, and then you've got to react fast to headlines.
Yeah.
And that's why it can be difficult to know that.
Do you trade different ways before and after the event, or it's like the same thing that you trade?
No, I don't at all. Trading's trading. But you'll find, I think the stage 3 is probably the easiest, because you get less headlines. The market knows the fact, and it's kind of like the herd mentality. You'll get some big dog who comes out and tells you that this is what it means, and then you get people like me saying, "Oh, this is what it means," and it's kind of same. But everyone sort of forms an opinion, and you generally, after a while, markets converge, everyone creates consensus, and that's when trends develop. Trends develop because everyone's doing the same thing, right? And that's kind of what we've heard. When there's such a big moving event, when everyone gets together and starts thinking as one, you get harmony and you get trends, and then you get order book dynamics playing through, where people go, "Oh, this is going up, I'm going to stop selling," and that's when the order book dynamics come through, and everyone's buying, and very few people selling, and people are prepared to pay higher prices. So, markets don't go up just because there's a buyer and a seller. People are also prepared to pay higher prices to get them up there. So, but going into the major event, you hear this sort of term which is bandied around all the time, which is markets hate uncertainty.
Yeah.
Well, it's the uncertainty of knowing what this event's going to look like. So if I take Brexit, as I say, we expect it to have a positive resolution. That's why pounds rallied from 124 up to 130. And but as we get a headline here that says, that suggests uncertainty, you get the pound coming off pretty sharply, because you've also got to remember, and this is one thing that we did at the banks, is how do you effectively price risk? And what we know is that over the years is that markets have shown us that we're all really, really poor at pricing political risk. Go back to the UK referendum in 2016. We saw massive volatility playing through in European and UK assets, massive volatility. You go back to the Trump election in 2016. We'd all gone into there thinking, well, most people thought that Hillary was going to win. A lot of people thought Donald Trump was going to win. But, how many people came out and said that, we'd see, the S&P futures, trade up 25% or so over the next few days, or we saw, once Donald Trump took to the stage, that we'd suddenly see, S&P, US Treasuries, sell off quite so as aggressively as you were supposed to see a collapse in world markets. Didn't happen. So plenty of people have predicted that Donald Trump would win, but no one had actually priced that actually it's going to hit the world with a massive fiscal stimulus at a time when monetary policy was very easy. And Keynesian economics is that's kind of like never happened. So, markets reacted.